Welcome back to my channel, Balance Sheets Matter. In this video, we're going to go over Stanley Black and Decker, ticker SWK. Myself, I'm more of a value investor. I do buy growth stocks, but at the end of the day, I'm always looking for stocks that have predictable futures, and I like buying them at really big discounts. And I think Stanley Black and Decker right now is a good stock for any type of investor they're looking at, whether you're a value investor, a dividend investor, or a growth investor. I think Stanley Black and Decker is offering a little bit of that to everyone because it has a pretty good dividend yield at 3.47%, and with this severely crushed stock price right now trading under $100, I do think it has at least upside to double over the next few years, which growth investors should be very interested in too. So I'm going to dive into the financials now, and I'm going to show you what the good things and the bad things are with Stanley Black and Decker. Now, a lot of my other videos, I just go over and I'm just saying, oh, everything's great in the financials. This is not the case with Stanley Black and Decker. There are some red flags we have to look at, and this is one of the reasons I held off so long for buying the stock when it was basically falling all of 2022. But at this price now, even considering those red flags, I think it's a great value to buy. So let's dive into the financials. So the first thing we can see here in the revenue growth, they do have overall this steady long-term revenue growth. The blue line's the average. They do have flat periods, they do have up periods, but in the long term they all are going up. The way they mainly do grow is a lot of it's through acquisitions, which we'll be going through in the financials. So this is something you need to pay attention to, how the company actually does grow and is producing that growth. And the revenue growth isn't too stellar. They average about 4.5% a year. So it's definitely not a big growth stock, but you can get growth stock-like gains buying these stocks when they're severely suppressed in price. So let's dive right into the financials, into the income statement. And I first always like looking at the top line revenue growth. You can see top line revenue growth has been very good, although they are economically sensitive. You can see when there's the great financial crisis from 2008 to 2009, the revenue dropped from 4.4 billion to 3.7 billion. So, well, the revenue growth didn't drop recently. What did happen is their gross margins got hit. As you can see right now, their gross margins actually the last year are down to just under 22%. They were 25% last year. And this is a comparison to where previously their gross margins were in the mid 30% range. So this is a really big problem. And it's one of those things, if this is a steady trend and a long-term trend that starts developing, there's some serious competitive edge the company's having. And we need to determine if Stanley Black and Decker is losing its mode, it is losing its competitive edge, or there is another issue. Well, I think this is mostly just the macro global economic problems that basically everyone was occurring between the supply chain issues that happened after the lockdowns and the inflation problem that happened in 2022, which has been a double hit for them. So I'm going to go over that a little bit later once we hit the balance sheet and the income statement, but just keep that in mind and let's continue here. So we can see coming down, their operating income has always been pretty good. They were in the previous years doing quite a bit, and because of this lower gross margins, their operating income has completely been crushed. And unfortunately, with their operating margins being crushed, they still have to pay a lot of interest because they do have a lot of debt. And frankly, I don't think they have the best debt ratio. Before, it wasn't as bad. When you're looking back at 2019, 2020, well, they're paying over 200 billion on 1.6, 1.7 billion in income. Not terrible, but now when their income's completely crushed and interest rates have gone up, they've paid $351 million in basically net interest. And that's more than their operating income was. So that's not a good sign. Another line here, which is showing a loss. A lot of investors don't understand what this is. It's just labeled other income expense. This is typically losses from them writing off goodwill on their balance sheet. So we continue down the statement here. Other thing to watch basically is in the opposite of basically the goodwill is when you're getting a gain here on this other net income. This is because they've sold the business, at least in Stanley Black and Decker's case, they sold the business and they made a net gain for it. So while they do focus a lot on acquiring businesses, and a lot of times you are writing off goodwill in the long term, at least some businesses they acquired and then parts they resold, they made a gain. So that's actually a positive. It makes me feel a little bit more confident in their ability to do acquisitions. And we can see their net income has been pretty consistently profitable over the years, although they did have some losses basically in 2022, 2023 from all these issues we were previously talking about. And their net margins, this is a really important thing to watch. We need to see if they have stable net margins. Are these declining? Are these going up? These make very big impacts in our valuation for Stanley Black and Decker. You can see it does bounce around. On the low side, it's been 2.6%. On the high side, it's almost been 10%. But relatively in the long term, it has been pretty stable. And we can see they have had pretty stable EPS growth over the years. For their shares outstanding, they obviously back here in 2010, 2011, they did some big acquisitions, issued a whole bunch of shares. They've been slowly buying them back, not at the most consistent rates. I'm going to get into the share buybacks a little bit later. I'm not quite happy how Stanley Black and Decker has been managing their share buybacks, and I think they could do this a lot better. So let's pop into their balance sheet now, because remember, balance sheets matter. And first thing I like to look at, current assets, 7.8 billion over the current liability, 6.1. So this is a positive current ratio. It's good. The one problem is, though, which relates to all these supply chain issues, is their total inventories. Their total inventories are right now sitting at 5.283 billion. And this is a comparison back to, say, 2019 or 2020, where they're only 2.2 or 2.6 billion. So this is part of the supply chain issues. A lot of these different companies purchased way too much inventory, and because of all the supply chain issues, they're paying $20,000 on a container, $25,000 to get a container, and when normally a container is only $4,000 from China. I have my own business. I import products, so I'm quite aware of this. And container prices have come back down, but back in 2022 and 2021, and even 2020, like the latter end of 2020, it was really bad. And Stanley Black and Decker, like everyone else, got trapped in this. This is the big headwind they have, but this is overall macro issue. It isn't specific to them, which is why I think they're going to be able to get over this. So one other thing to look at these total inventories is we can look at some of the ratios. So if we scroll up here on Guru Focus, they got the little ratios tab, and we can quickly look at some of these, and you can basically see their inventory to revenue. So this is how much inventory they keep to their revenue. So obviously the lower number, we just want to see what their average was before. And you can see it was about 0.1, maybe 0.14 in the past. In 2019, 2020, it did creep up a little bit, but it ballooned up to 0.37. So think about it. The amount of inventory they're holding right now compared to their revenue, and compared to some years, say about 5-10 years ago, is about 3 times higher, which is a little concerning. But again, this is overall a macro phenomenon, and hopefully they're going to be able to work through this issue. They have lowered their gross margins, which is probably the reason they are going to be able to sell through it. And then another thing to look at is the inventory turnover. This is how fast they turn over the inventory each year. You can see normally they would turn over the inventory between 4 to 5 times each year, and now it's dropped down to 2. So they obviously are sitting on a lot of stagnant inventory, which basically has led to this decline in their gross margin. This is the core problem with Stanley Black and Decker, and we're going to need to closely monitor to watch this improve. If other basically competitors and peers are improving and they're not, that'll be a big red flag. So we want to see progress on them getting down their inventories and then starting to get up their gross margins in the future, to hopefully this company will recover and we're going to make some big gains on it. So let's continue going down the balance sheet here. As we can see, basically the total assets are sitting at about just under 25 billion, although it always is important to look at the goodwill, because goodwill is kind of the extra amount that gets added in when they do acquisitions. It's not really real in any way. You can't sell it to anyone, and that's sitting at 8.5 billion. So and then we look at their long-term liabilities, their total liabilities of $15 billion. $6.1 billion is long-term debt. They have unfortunately taken on more debt recently, which is why they're paying higher interest expenses. And that leaves them with 9.5 billion of total stockholder equity. Although remember, 8.5 billion of this is goodwill, so in reality they only have about 1 billion in real equity on their balance sheet, and a lot of that is just in patents and trademarks. So it's not the best balance sheet in the world, in my opinion. The balance sheet really does matter. I wouldn't give them any check marks for adding additional value with this balance sheet. But, it's manageable enough. A lot of companies, their size and their maturity, just kind of, keep their total stockholder equity flat after this. So, could be worse, but it's not great. So let's go to the cash flow statement. I mainly want to look on the cash flow statement and show you what they're doing and how they're growing their business. So you can see one of the ways they reinvest in their business is plant, property, and equipment. And you can see it's a little bit, it's not very much, it slowly creeps up over the years. But where the real money goes is in the purchase of businesses. This is acquiring other brands and other companies, building out their line of products and putting in their supply chains. So you can see, like, 2 billion 2021, 2.5 billion 2017, 1.3 billion 2020. They're spotty. You're not going to be consistent every year, but that's where they put a lot of their money. And recently they did do a sale of one of their brands for 4.1 billion, which they previously, I think it was, they made about $800 million on. So overall, this is the core business. They need to be making good acquisitions. If they make questionable acquisitions in the future, overpay, this could lead to the stock price dropping. So then let's see how they basically return cash to their shareholders. As we can see on the issuance of stock and repurchases of stock, they do a little bit of issuance of stock. It's not a huge amount. It seems to be a little bit spotty. And the repurchase of stock is also a little bit spotty. It does tend in the long term to exceed it. And the one thing I don't like is they did this huge purchase of stock. And this was the beginning of 2022. And if we go to the chart here, let's just zoom in here so I can show you that where that was. It was right here. They're basically reinvesting and putting all their money into the stock when the stock price was relatively high. And this is why I think that, like I was saying earlier, Stanley Black and Decker has not done a good job in basically allocating their capital through share repurchases. I would prefer them to consistently purchase a little bit of stock every year. You don't need to time the market, but if you can just do it consistently every year, you're going to get a better long-term average than investing, basically half the money you made from this sale where they got, $4 billion from. Investing it basically at the highs would have been much better if they just focused off paying down more debt, which they have been doing some payments of debt, but this is $2 billion. They could have paid down more debt, which would have been a lot better for them. And of course, for the dividend from cash flows, as you can see, slowly ticks up over the years. I think they can quite easily afford to pay their dividend. If they did have a lot more headwinds going forward, this obviously could be cut, but if they do have a recovery path and the recovery path starts going well, then I would expect them to continue paying this dividend. And if they do buy back more shares, your dividend yield is going to go up as well. And then we can see on their free cash flow here, other than these last few years, they've always had free cash flow. And again, instead of taking all that debt and having negative free cash flow, if we just took that money instead of repurchasing stock and we paid off debt, I would have liked that so much better. This is one of the reasons why I wouldn't be a buy and hold investor for Stanley Black and Decker. I like to buy the stock when it's cheap and sell it when it's fair valued or expensive. Now let's figure out a good value for it. I'm going to pop into their interactive chart here. I always like to do a relative valuation to get an idea. You can see over long term, they had their big rise, they've had a big fall, but what does that mean? One of the things I like to always look at is the price to sales ratio. And as you can see, in the long term, basically, the price to sales ratio has been in this range. And over here was quite overvalued. And when it gets here, it's quite undervalued, as we can, throw up the price chart on top. And if we had basically bought Stanley Black and Decker every time the price to sales ratio got to these lower levels, we would have been basically quite happy. Although, why does this work with the price to sales ratio? Well, it's all dependent on what their net margin is doing. So let's pop up their net margin and see if it actually makes sense. And you can see there that, well, we went over before actually, well, the net margin does whipsaw a little bit back and forth. The long-term trend is pretty steady. So this actually makes the price to sales ratio quite a consistent metric to value Stanley Black and Decker at. And if we bring that back up, we can see it's relatively trading at quite a significant discount. And also because of Stanley Black and Decker's misallocation for capital and a few little issues, this is why I wasn't interested in buying it potentially up here when the price to sales ratio is maybe 1.4, which can look relatively cheap, but they're having a bad time. So I need bad time pricing, which is like 2008, 2009, 22, 2023, and maybe, 1999 to 2000 there. So another way you can actually value dividend stocks and value stocks like this is by looking at their historical dividend yield. If they're actually making consistent cash flows, they can pay a consistent dividend. You can actually just find the stock is cheap whenever the dividend yield is high, because when the price goes down, they're paying the same amount of money. The share price is lower, so that means the total yield per share is higher. So you can see here all the high times. If we had bought that, let's overlay the price, pop it up there, and you can see right here, it's looking like a good time to buy. If we bought in 2009 when the dividend yield was high, we would have bought at the bottom. Same thing in 2003. Same thing in 2000, though it was high this whole time, but you can see it was just choppy at the bottom. And the reason why I like stocks like this, when you do actually have those dividend yields, is if you do have to hold it for a while, at least you're getting some return back for the dividend yield while you're waiting for it to increase in price. And now let's look at a little bit of the forward estimates by bringing up the revenue with estimate and the EPS with estimate. This is kind of the projections are from the conglomerate of analysts. You can see right now it's been going down, but they are expecting it to increase in the future. So we want to make sure the estimates like this maintain going forward. If they do get brought down, that is going to be a concern for us. But if the EPS do go back up and stay on this track, this is a really good sign for. Sorry, I just cut off a little bit there. My computer actually just crashed. I usually just do these videos in one take, but it crashed. I had to restart it, but I did the last thing I want to go over is I did want to look at the chart, look at a few little technicals, like to look at basically how I like to look at the long-term trend for companies, combining the fundamentals and the technicals. So you can see right here, I have a little pitchfork channel for Stanley Black and Decker, and this kind of is showing its very long-term trend. And you can also see I have these moving averages showing the long-term trend as well. And typically, if you can match basically a long-term trend with their fundamental long-term trend, it can kind of help you also determine a pretty good spot to buy it. So you can see right now we're quite near the bottom of our trend. The RSI is oversold. It's starting to come back up. The MACD is starting to curve up as well. The momentum is starting to look good. This is technically looking very, very constructive for Stanley Black and Decker. And if we had every time, bought the stock when it started getting these lower moving average ribbons, we would have been very, very happy. But on the upside here, I'm really only looking for maybe a reversion at most to this kind of mid-top trend line here. So, in the next couple of years, that could be, 200, 250. Maybe I'll sell it earlier as low as 180. I'm going to have to see how things play out. Depending on companies' quarter-to-quarter results, if they start having some really big booms, that might be a reason to hold on and just really let the stock run. But probably definitely, if this starts getting to this upper trend, I am 100% going to be selling the stock. That's where I'm going to be taking profits. As I said before, for the issues with Stanley Black and Decker, I'm not looking at, frankly, doing this as a buy and hold forever stock, but I might be a shareholder over the next several years. I hope you like my analysis on Stanley Black and Decker. Remember to like, share, and subscribe to my video. I'm going to be trying to put out more stock analysis videos, basically getting ones out daily. So if you want to look at other stock analysis and get other stock ideas, subscribe to my channel, and I'll see you in the next video.